Thank you very much, and please join me in welcoming Ian Whittaker to the stage.
Hi everybody, nice to be here. As Greg mentioned, I'll be doing the year ahead, giving some thoughts on the macro environment and then what it means for the sector as well. For those who don't know about me, I was an analyst in the city for 20 years. I covered the media and tech sectors. I was twice analyst of the year during that time. 3 years ago, I set up my own advisory consultancy firm, Liberty Sky Advisors, advising clients in the space. Greg very kindly mentioned that I talked about what I predicted back at the start of 2023, and if anyone does want the original presentation, time-stamped, I'm very happy to share it afterwards. These are my macro predictions back in 2023. I was essentially saying that I did think, I know there is a wrong one coming up, don't worry about that, that essentially things would generally be actually a lot better than what people were expected in that, and that generally proved to be the case. Media and tech ones, as I said, there is one wrong there. Television, which essentially I thought would do a lot better than it did within there. But generally, again, it was a good year for when you look at the advertising sector, when you look at the tech stocks, generally it was quite good. And also what we don't tend to talk about in this environment, because it's not really advertising, boring media stocks, professional publishers, for example, music companies, they all did very well. So actually across the spectrum of the media space, actually things were pretty good in 2023. So what about 2024 in terms of the outlook and what thinking there? Well, we go into this year with essentially a turnaround in where the consensus is. The right-hand chart shows the expectations at the back end of 2022 about what 2023 would look like. What it shows there is this was a forecast of an economist done by the Federal Reserve in the States, looking at the probability of recession over the coming 12 months. For those who can't see, it was the highest prediction of a recession well in the 50, 60 years of the survey's timeline. Nearly half of economists predicted a recession. If you look on the left-hand side to see where people are now, there's more a benign view of where the world is. And I generally share that view in terms of where things are. We'll come on to slides in a minute, but you look corporate profitability, consumer spending, where overall of people are, although I would say that particularly low income parts of the population definitely under pressure in terms of things, but generally when you look at the environment, things look relatively benign. Interest rates, this will be a big driver for the sector, and again we'll have a couple of slides on here later, but bear in mind that probably one of the biggest factors that you've had influencing both what's gone on in the stock markets, but particularly areas like tech, and indeed going down into advertising and media generally, is what's happened in interest rates over the past 2 years. The reason why actually a lot of tech firms went from spending a lot on advertising up to around the first half of 22 and then slashed their spending was because interest rates went up so dramatically on here. So what happens with interest rates is important across the board. For the economy, for the stock markets, what indeed happens with many of these firms as they spend. And as I say here, it's very likely as we look at where things are now that interest rates will come down from where they were. However, they're not going to come down to where they were back in the COVID days of 0%. I think those days are very much gone, and reasons for that, if any single biggest factor for that is that central banks, just because of their credibility, will not get down to those levels again. We can argue about the causes of inflation and what happened there and so on. So we are going to be in an environment that probably historically low in interest rates, but again, we're not going to have the era of free money that we had before. However, corporate margins should actually do very, very well on here. Chart on the left-hand side from Bloomberg shows US corporate margins on a 70-year view. You can see on there that actually historically at very high levels. And probably if we were to roll that forwards, going into where we were back end of 2023, that would have gone up again. The markets, this is the right-hand side, it's the S&P 500, which is the main US stock index on there, and where analysts are forecasting for companies where their earnings will grow. For 2022 to 2023, fairly flat, but you can see on there probably around a 8-9% increase for 2024 and a similar increase for 2025 as well. So the markets again are thinking that actually corporate profitability should hold up well. And actually, for many sectors, it may be the case that that is true, and particularly thinking here about the CPG space, but also you could argue things like airlines and so forth. This is some research. I mean, it's not necessarily the sort of research itself that's important. I did sort of some numbers looking at Pepsi, just an example, saying, okay, because they've been able to push through higher prices to consumers, it's boosted up the organic revenue growth rate. And therefore, essentially, what would be the drop through to profits if you did that sort of and roll those the impact of that forwards? You can see there sort of longer term could be around $700 million impact altogether. Now, the point being with this is that essentially what the inflation of the past 18 months has allowed many companies to do is actually put through several years, almost close to a decade of price increases through in the matter of 18 months. Now, those price increases are going to be very sticky on there. Companies usually, when they raise prices, they don't bring them back down. But many of their input costs are actually going to come down on here. And so what potentially you would get here for many companies is actually structurally higher margins coming through within their space. It's not necessarily a message that they want to say publicly. There's too much political risk in there at the moment, particularly with the accusations of greedflation. But if you do the numbers, look at the impact on what the organic revenue growth rate has been, feed that through over the medium long term, that is the logical conclusion of what has happened over the past 18 months. Now, in terms of the consumer, the consumer, as I said, the consumer is mixed. You're essentially lower demographics. There are some signs of pressures. You look, for example, in the US, what's happening in terms of default rates, they are starting to go up. In terms of consumer loans, debt is starting to go up. But generally, when you look at the entirety of the consumer base, it's actually holding up well. Probably the keys are unemployment. If you've got a job, you're generally going to be quite happy with things. Wage inflation generally hasn't kept up with inflation, but it's doing okay on the scheme of things. And if you look across most major economies, the US, the UK, even for the Eurozone, unemployment rates are actually at historically low levels. However, it is not necessarily going to be all a sort of optimistic environment. I think one thing that wouldn't expect to come back is the Chinese economic recovery in 2024. China disappointed in 2023 with what happened, and I think again in 2024, we're not going to see a rapid bounce back in terms of growth, despite what the authorities are trying to do over there. China at the moment has got many problems. If you look at it, left-hand side is in terms of their property market, which is a huge issue for them, both in terms of the consumer and also as well businesses going through a very traumatic time at the moment. But also as well, when you look at what's happening in terms of Chinese consumer and consumption and so on, investment, it's not really that great as well in terms of the environment. And despite what the authorities are trying to do, it doesn't really seem to be sort of kicking through. Inflation, I think it's going to be stickier than thought. I don't think we're going to get back to pre-COVID levels. This is a chart showing essentially freight routes from the Far East going into Europe. The red circle there is the Red Sea. Normally, most traffic would go through there. That's been blocked because of what's happening with the Red Sea attacks. What's not on this chart is at the other end of the ocean in the Panama Canal, ships are limited going through because there's a drought. So what you're going to have is supply chain issues here that are going to push up prices. Who knows how long that will last. There are other points as well. China itself, if you look at it, it was a big contributor to global deflation over the past 20 years. Those effects are unwinding. More and more firms are bringing their operations back to the home market. So again, inflation's likely to be stickier. This, of course, is what's going to be key. The elections, over 40% of the world's population goes and votes in 2024. India, Indonesia, these are probably the three most important from a global standpoint. Taiwan on the right-hand side, they actually go and vote on Sunday on there, and obviously the implications of that could be that you could get more turmoil happening in the Far East if the results, China doesn't like the results. So that's something to look out for the immediate term in terms of economic outlook. The UK probably comes in November, and again, bear in mind both US and UK, governments never like to go into an election essentially sort of with a downbeat economic message. So expect sort of in these countries, expect them to try and do things to boost the consumers. And this is why I think, for example, the US, UK will see lower interest rates, we'll see tax cuts, generally be a quite benign environment. What does it mean for media and tech? Might as well do AI up front. I put on the right-hand side here, my background is historian and more recently a war historian. what the debate about AI really reminds me a lot of is the debate that's gone on for the past 30 years in terms of technology transforming the military, and it hasn't happened yet. You know, and there's been disappointment after disappointment after disappointment, and a lot of the arguments used for AI are similar to what's been used for the military here. I think what we're going to see here in 2024 is we're going to see a pause for breath. We had a whole load of excitement coming through in 2023 about AI, but actually if you think about the practical implications of AI and what it means, I think a lot of companies are actually going to struggle to sort of translate that into hard effects. I think probably the most likely one you'll see is that corporates will use it as an excuse to say we should downsize our employee base. So I think you are going to start to see, as indeed you have with companies like BT, longer term sort of redundancy plans with people saying we can get rid of a stream of jobs because we can introduce AI, even though the technology itself hasn't really been proven. Now, tech had a great year last year in terms of its share price performance. These are for the Magnificent Seven, as they're called. So you read the names on the bottom there. You have someone like a Meta nearly double their share price, for example, off there. Is it likely that this will happen again? My feeling is at the moment, no. I think, you know, that sort of the strength of tech, particularly Meta, caught people by surprise. I think that's baked into analyst forecasts for next year. And just from a simple sort of maths perspective, it's very hard to actually sort of repeat that growth again. But I do think actually tech generally, in terms of both its operational performance and its share price, should do quite well. But I do think advertising is going to be healthy this year. This chart here is from ProSieben, the German broadcaster. They did a survey of their clients, 1,000 clients that were listed around 4 years ago, which effectively looked at, for those advertisers on the left-hand side, those companies that expected to meet their revenue forecasts. And what they found was that they kept their advertising spend the same. But what they found for those companies that are actually missing their estimates was that on average they cut their advertising spend by 10%. And so go back to the point that's said before, you know, that in terms of corporate profitability is holding up very well, should continue to do very well, and the reasons for thinking that structurally it should actually grow from here we are now. If that does roll out, then what you're likely to see is that you'd like to see continued marketing sort of spend coming through. And I don't think this is a cyclical thing. I think this is probably more of a medium to longer term thing that's coming through in the industry. Now, I am going to sort of stick my neck out again and risk a second time I've been wrong on this. I do think the broadcasters will do okay. Apologies for those who can't see this. This is from ThinkBox. It was for online-born companies, sort of, and what they spent on TV from 2019 to 2021. Now, I'll read out some of the numbers here. 2021, sort of online-born companies made up 21% of all UK linear TV ad spend. They grew from 2020, 42%, and they grew from 2019, 47%. These are not sort of, you know, you've got the Googles and the Metas in there, but actually the ones who are the biggest spenders, your delivery companies, you're essentially used car companies. These are all companies that when interest rates went up and went up sharply, they didn't just cut back their advertising spend by 10%, 15%. Literally, it would have gone 50% plus overnight. And so consequently, I think what's happened a lot with TV is that one of the biggest factors here is the pullback of spend from those types of companies. And again, you add on to that VC firms have been under pressure to actually cut because of higher interest rates as well. It's had a dramatic effect in terms of these areas. So my feeling is at least some of this spend will come back, even if it doesn't come back. So I'm not predicting a fantastic year for TV, but I think it will do okay. Retail media, very much the focus of what people are doing. And these are figures on the left-hand side, Walmart and Amazon, in terms of their growth and so forth for advertising. I think the key thing to bear in mind with retail media is very high margin for these companies. Retailers make, at best, high single-digit margins. The A&A in the States reckons that retail media margins are around 50 to 70%. You don't have to make that much revenues on those to actually get sort of a big impact on the profits. I mean, for Amazon, for example, I reckon over 50% of the profits is now coming from advertising. Like the single biggest contributor to profits. SVOD, I mean, I've been negative for several years now on SVOD. I just don't think that the market penetration is just there for them. And I think what you will see in 2024 is you'll see this flatlining coming through. it'd be hard to see further penetration. The focus very much will be on ARPU growth going forward, simply because if you're going to go your revenues, subscribers times your ARPU. Subscriber growth is limited. You have to focus very much on the ARPU growth, and that's what they will do. But you look at all major markets now, you're starting to see SVOD actually flatlining. Do I think there's going to be any mergers that come through? I think my feel is that Discovery and Warner won't actually happen this year. I think it's probably more likely to happen in 2024 if it does. And don't expect much M&A sort of within the space as well. I mean, again, sort of famous last words. I think there will be some activity. You've got Vivendi, for example, saying it's going to spin off Havas as an independent agency, Canal Plus in the pay TV business. WPP have got their Capital Markets Day on the 30th. Don't be too surprised if you see something there. Interpublic has started to sell off agencies. But the reason why I put up the picture of a tank and an electricity grid, capital is limited at the moment. Interest rates, as I say, should remain quite high. The amount of availability out there for M&A is actually limited. And at the moment, investors are more interested in spaces like these than they are necessarily in spaces like media and tech, where they've actually lost a lot of money over the years. So conclusions would just say, I think, as I said, I think 2024 generally will actually be a good year. So it'll be quite benign. I think the advertising space will do quite well. I think there will be ups and downs as usual. I think pretty much in terms of media, we'll get a continuation of most of the trends of 2023. As I said, there could just be some grey swans which come through. And that's it. Thank you.